The latest Reserve Bank of Zimbabwe 2023 monetary policy statement indicates that the banking sector made a profit of Zimbabwe dollars 503 billion for the year ended 31st December 2022. That's a 749% increase from the 59 billion Zimbabwe dollars reported in 2021. So of course the issue is, how are financial institutions making this profit? But more importantly, what is it actually composed of? Now, the growth in the banking sector income is made up largely from non-interest income, which constituted 68% of total income as at 31st December 2022. That's up from 54% in 2021. Now, non-interest income is bank income derived mainly from fees charged on customer accounts and, of course, transaction fees. I'm sure you all know what I'm talking about. Now, ZB Financial Holdings Limited Group Finance Director Emma Mungoni told the Mint that increased digitalization and inflation has led to high non-interest income on banks' income statements.
Significant deposits in the market are transitory in nature, in the sense that they are moving, they are not staying with us. And when you find the bank charges, it's because of the volume of sheer volume of transactions that has gone up. When you're looking at interest income on the other end, it's savings and it's funds that would be sitting on our positions that we can then on-lend to customers, to institutions. So you find that we've got a significant number of transitory deposits, as well as an increase in volume of transactions. Hence, you find that revenues are skewed towards non-funded income vis-a-vis funded income.
Now remember, traditionally, banks' primary source of income should be interest income. That is the income made from them lending out your money in terms of into loans and advances to customers. So I ask, can banks survive on such high non-interest income? Is this profit, the way of them making profit, sustainable?
78% of domestic transactions are in US dollars. And when you look at these domestic transactions, 90% are at an individual level. And again, that is in cash. So you don't go to the tuck shop and you swipe. You usually go to the tuck shop and you've got cash. So already that's a threat in terms of the bank charges and in terms of the formalization of that market.
Now, economist Victor Boroma has said that inconsistent policies in a volatile economy has made banks depend on non-funded income because it has less risk.
But I would say the primary focus should be on how banks make money. Banks make money from interest. So now, if you lend money, to producers, the business sector, for you to be able to make money, it means there has to be a stable economic environment. There needs to be policy consistency. There also needs to be positive, interest rates. So when inflation is running at 300%, you cannot have a situation where interest is at 200%. It means it's a loss before you start anything. So those three key issues are very important to the banking sector: interest rates, stable economic environment, and also the policies and the regulations that govern borrowing and paying back. When you've got a situation where the market borrows in USD and pays in ZIM dollar, it literally means that banks make losses and they cannot go there and sink again. So they would rather stay where it's dry. They do not go deep. That means they hike their fees, point of sale charges, transaction charges, your bank levies, your monthly, book charges. So that's where they are getting most of their income. Why? Because the operating environment, which is supposed to give them profits, is not to their best, is not conducive for them to be able to make profits. So that means once you align that, inflation being stable, money supply growth, which is between 10 to 15% of GDP, positive interest rates, laws which are stable.
Okay, so what is apparent is that for now, banks will continue to make profits and make handsome profits from what critics call playing the middleman. Now, will this be a permanent feature in the financial services sector? I think it may just be.